Notice how many people with good salaries still feel completely broke by the month's end? They aren't struggling or panic-stricken, just permanently tight, despite doing exactly what they were told. Take a standard scenario. You earn a solid income, seemingly respectable on paper. But after taxes and insurance, the actual monthly take-home is significantly lower than expected. Rent or a mortgage immediately claims $1,400. Utilities and basics take another $250. Then comes the car payment, insurance, and student loans. Money leaves faster than it arrives. Groceries and subscriptions add up. Before buying anything extra, your balance is already near zero. This is where consumer debt enters. Not as a crisis, but as a convenient bridge. It fills the gaps. Weekend trips, phone upgrades, or furniture, because the old felt outdated. Nothing looks reckless. In fact, it feels normal to finance life slightly ahead of income. The system quietly adjusted lifestyle expectations much faster than incomes could actually keep up. A $6,000 balance feels safe, but minimum payments turn it into $9,000. A $30,000 car loan eventually costs $36,000 out of your future freedom. There is no single bad decision, just a series of small, socially approved financial leaks. Psychologically, we focus on monthly payments, ignoring the massive total cost accumulated over years. Social pressure raises the baseline of normal. Saying no feels unnecessary because you earn decently. You tell yourself you will earn more later. That future income becomes mentally pre-spent today. Years pass, salaries rise, but debt remains. You aren't failing, but you aren't building either. Financially intelligent people see debt not as a tool, but as a claim on freedom. They calculate how many future months of life they trade away, not just today's payment. Stop asking if you can afford the payment. Ask what this delays for your future. If this perspective made things clearer, consider clicking the subscribe button for more insights.